No one likes losing money on an investment, but sometimes realizing capital losses can enhance your bottom line by deferring your tax bill while you patiently wait for markets to recover. Tax loss selling, also known as tax loss harvesting, is a technique for realizing or crystallizing capital losses in your non-registered accounts so they can be used to offset taxable capital gains. And by deferring the taxes on your capital gains in your portfolio, you'll give your money more time to grow. I'm Justin Bender, Portfolio Manager at PWL Capital. In this episode of the Canadian Portfolio Manager, I'll show you how to push your tax bill into the future by implementing a systematic tax loss selling strategy with your ETFs. To be clear, there is no benefit to tax loss selling in your TFSA or RSP. This entire conversation only applies to your non-registered accounts. As an example, suppose you invest $100,000 in a Canadian equity ETF and then the value declines to $90,000. By selling your shares, you can crystallize a capital loss of $10,000 and potentially use that loss to offset a $10,000 capital gain elsewhere in your portfolio. So by deferring thousands of dollars in taxes, there'll be more money left in your portfolio to compound over time. Tax loss selling may sound like the cardinal sin of selling low, but I'll explain in a moment why, when properly executed, it's not the case. Before engaging in tax loss selling, it's important to ensure your tax strategy is based on accurate information. It's your responsibility, not your brokerage's, to ensure your adjusted cost base, or ACB, is accurate and up to date. This includes making adjustments for buys, sells, drips, return of capital, reinvested distributions, and unit splits. So for more details on how to track your adjusted cost base, please feel free to download our white paper, As Easy as ACB. When you file your tax return, any capital losses must first be used to offset capital gains you've incurred in the current tax year. Any remaining losses can be carried back for up to 3 years, or carried forward indefinitely to offset future capital gains. And to carry back current capital losses to prior years, you need to file Form T1A, Request for Loss Carryback, with your return. Now back to that selling low conundrum. You may be wondering if it's wise to realize a capital loss by selling a security that plays an important role in your portfolio. If you're holding individual stocks, it probably isn't very wise. Say, for example, your Royal Bank shares are down in value, and you sell them to capture the capital loss. What if you then end up missing a big upward move in that stock? To harvest the loss but not lose your position, you might figure you'll just turn around and buy back more Royal Bank shares at the new low price. In this case, the Canada Revenue Agency, or CRA, will declare your loss a superficial loss, and you wouldn't be able to use it to offset gains. This is why investors who buy individual stocks have limited opportunity for tax loss selling, and it's yet another reason why ETF investors have an advantage. By following the techniques in this video, you can systematically harvest capital losses, maintain exposure to all the asset classes in your portfolio, and comply with CRA's rules. So again, the CRA does not allow you to sell a security and crystallize a loss, immediately buy it back, and continue to hold it. If you do that, your claim will be denied as a superficial loss. And bottom line, the CRA doesn't think much of you playing shell games with your taxable holdings. So they require you to abide by a 2-part superficial loss rule. And by the way, you includes people affiliated with you, which includes your spouse or a corporation controlled by either of you. So whoever you are, you cannot A, buy or have the right to buy the same or identical property during the period starting 30 calendar days before the sale and ending 30 calendar days after the sale. And B, still own or have the right to buy the same or identical property 30 calendar days after the sale. In Part A of this rule, the period spans 61 days, the settlement date of the sale, plus 30 calendar days before and the 30 calendar days after the settlement date. Part B sounds redundant, but there's an important subtlety. You can buy the identical security anytime during the 61-day period, but you must ensure you don't still own it by the end of the period. If you do, the loss will be denied and added back to the adjusted cost base of the identical security. As mentioned, the The 61-day period includes the settlement date of the sale, as well as the 30 calendar days before and after the settlement date. So if you sold your ETF at a loss on March 23rd, 2020, the settlement date of the trade would be March 25th, as ETF trades settle T+2 or 2 business days after the trade date. When determining settlement dates, skip over any weekends or holidays when the Canadian stock markets are closed. From this point, you would count backward 30 days, this time including weekends and holidays, bringing you to February 24th. And then count forward 30 days from the settlement date of the sale, bringing you to April 24th. This would become your 61-day period. You would then ensure all purchases of the identical securities settle outside of this 61-day period, unless you plan on selling these shares before the end of the 61-day period. The good news for ETF investors is that you can avoid the superficial loss rule while still maintain exposure to the same asset class by using similar but slightly different holdings. Remember, the superficial loss rule only applies if you sell and then repurchase the same security or an identical property. And in 2001, the CRA issued a bulletin stating that 2 index funds tracking the same benchmark are considered identical property. For example, according to this interpretation, you cannot sell the iShares Core S&P TSX Cap Composite Index ETF with ticker symbol XIC and just replace it with the BMO S&P TSX Cap Composite Index ETF with ticker symbol ZCN, as they both track the S&P TSX Cap Composite Index. Other less obvious examples of identical property would include the Mackenzie Canadian Equity Index ETF with ticker symbol QCN and the TD Canadian Equity Index ETF with ticker symbol TTP, which both now track the Solactive Canada Broad Market Index. Vanguard, BMO, and iShares all have funds tracking the S&P 500 index, and these two would all be considered identical property according to the CRA. However, it is possible to find pairs of ETFs on the same asset class that are similar but track different indexes. For example, you could sell the Vanguard FTSE Canada All Cap Index ETF with ticker symbol VCN and replace it with the Franklin FTSE Canada All Cap Index ETF with ticker symbol FLCD. Although their names may sound similar, VCN tracks the FTSE Canada All Cap Index, while FLCD tracks a slightly different index, the FTSE Canada All Cap Domestic Index. So by selling your existing ETF and repurchasing a similar but not identical property, you can realize a capital loss and still maintain similar asset class exposure in your portfolio. Identifying acceptable pairings can be time-consuming. In an upcoming video, I'll provide my suggested ETF pairings for 2020. But for now, we'll cover some additional details to bear in mind first. As your replacement ETF is a similar but not identical holding to your original ETF, it's unlikely the pair's performances will be the same over the 30-day period. For example, suppose you initially purchased $100,000 of VCN, and during the recent pandemic, you check your account on March 23rd and find your VCN holding has dropped to $68,000. You sell all units of VCN and use the proceeds to buy FLCD, realizing a $32,000 loss in the process. After 30 days have passed, you sell your FLCD holdings and repurchase VCN. During this 30-day period, the replacement ETF happened to outperform the original ETF by about 0.05%. This low tracking error is an ideal result, but things don't always work out so well. There's also a risk the replacement ETF will underperform the original ETF during the 30 calendar days after the switch. If properly selected, your tax loss selling pairs should have minimal tracking error with minimal performance differences between them. This low tracking error is also a good reason to consider holding on to the replacement ETF instead of switching back to the original ETF after 30 days. If both ETFs are expected to perform similarly going forward, and there's no way to determine which will slightly outperform the other over your investment horizon, you're really just flipping a coin at this point. It's also possible to trigger a partial superficial loss, whereby only a portion of the capital loss is denied. This would occur if you or yours, as previously defined, buy back fewer shares of the identical property during the 61-day holding period, and you're still holding these shares at the end of the period. For example, suppose you purchased 3,000 shares of VCN in 2018 for $100,000, and on March 23, 2020, You sell all 3,000 shares for $68,000, resulting in a capital loss of $32,000. You immediately purchase FLCD with the proceeds. On the same day you sell your 3,000 shares of VCN, your spouse decides to rebalance their portfolio by purchasing 300 shares of VCN in their TFSA, which is the same security you just sold at a loss. Your spouse continues to hold these shares until after the 61-day period ends on April 24, 2020. As your spouse purchased back 300 of the 3,000 shares you had initially sold, 10% of your $32,000 loss will be denied. This will result in a partial superficial loss of $3,200, reducing your actual $32,000 loss to $28,800. Some spouses prefer to keep their finances separate, but this example illustrates the need for spouses to coordinate their investment strategies, especially when tax loss selling. Enrolling in a dividend reinvestment plan or DRIP program through your brokerage account is also a surefire way to realize partial superficial losses. If you or your spouse have a DRIP set up on the same ETF that you decide to sell for tax purposes in your non-registered account, a portion of the loss may not be allowed. This is why I recommend canceling all DRIPs in your accounts when implementing a tax loss selling strategy. Continuing with our example, suppose your spouse also owns 3,000 shares of VCN in a TFSA that he or she purchased outside of the 61-day window. In April 2020, your spouse receives a dividend from the fund, most of which is used to automatically purchase 16 additional shares of VCN. If these 16 shares are not sold by the end of the 61-day period, you've just triggered another partial superficial loss. Multiple portfolio managers can also cause unintended superficial losses. Some investors feel that using more than one manager offers some diversification benefit. The problem is, it can cause major headaches when it comes to avoiding superficial losses. If one of the managers sells a security to realize a loss, there's no way for them to know whether another manager is buying shares of the same security during the 61-day period. Okay, so we've now covered several important ways to avoid taking a superficial loss as part of your tax loss selling strategy. These include keeping an eye on buying and selling similar but not identical ETFs, and avoiding partial superficial loss traps by skipping DRIP programs as well as multiple portfolio managers. But how often should you check your portfolio for these opportunities? And when does it make cost-effective sense to take them? Many investors and advisors pay little attention to tax loss selling until year-end. By doing so, they miss opportunities that arise from market downturns throughout the year. Consider an investor who purchased $100,000 of the Vanguard US Total Stock Market Index ETF with ticker symbol VUN at the beginning of 2020. A few months later, VUN had lost nearly 15% of its value, but by the end of June, it had made an impressive recovery. Our investor could have crystallized a loss of nearly $15,000 at the end of March, but a few months later, the opportunity had vanished. This is why I recommend keeping an eye on your non-registered accounts year-round, not just in December. Pay particular attention when you know your holdings are probably taking a hit, because market downturns aren't usually a big secret. Next, how big of a capital loss do you need to realize to make it worthwhile? As there are additional trading costs of this strategy, such as bid-ask spreads and commissions, it should be large enough that the ongoing tax benefit easily outweighs the one-time expenses from implementing the strategy. In his book, The Only Guide You'll Ever Need for the Right Financial Plan, Larry Swedroe suggests 2 requirements that should be met before engaging in tax loss selling. The security should have 1. A minimum dollar loss of $5,000, and 2. A minimum percentage loss of 5%. As an example, suppose you originally purchased $100,000 of VCN in your non-registered account, and your holding is currently showing a dollar loss of $5,000, which is calculated as your ETF's market value minus its book value. This loss meets the minimum dollar threshold of $5,000. VCN also has a percentage loss of 5%, which is calculated by taking the $5,000 loss and dividing it by the $100,000 book value. This loss also meets the minimum percentage threshold of 5%, so both rules have been satisfied. To realize a loss, you could sell all your shares of VCN and immediately purchase an equivalent amount of a similar, but not identical security. I've also heard advisors say that it only makes sense to realize capital losses if their clients have already realized capital gains in the current year or in the 3 prior years. They see no benefit to banking capital losses for later use. I disagree with this logic for a number of reasons. First, many Canadian listed ETFs tend to distribute capital gains at year-end, and these gains can be significant. By anticipating the need for capital losses to offset gains from these transactions, you can leave more money in your portfolio to grow. Second, most investors will need to periodically rebalance their portfolios by selling equities, which will usually trigger capital gains in the process. So having an arsenal of capital losses to offset these gains will also come in handy when filing your future tax returns. And finally, having capital losses carrying forward provides you with more portfolio management options. As new and improved ETFs are released, you may want to switch from a more expensive, less tax-efficient ETF to a cheaper or more tax-efficient ETF at some point in the future. That's it for today's episode. Thanks again for watching. I'm Justin Bender of PWL Capital, and this is the Canadian Portfolio Manager YouTube channel. If you enjoyed this video, feel free to also check out the Canadian Portfolio Manager podcast and the Canadian Portfolio Manager blog for more useful investing tips.